Welcome to the Broken Pie Chart Podcast. What episode is this? 276. I'm your host, Derek Moore, and if I can get to it, my semi-permanent co-host, Jay Pestrichelli, CEO of ZEGA Financial. All right, Jay, intros are out of the way. By the way,
broken intro for the Broken Pie Chart. Got it.
Yeah, at least we don't fill a bunch of ads at the beginning. You know, people have asked me, you're one of the few podcasts who don't take ads, and I'm like, no. I mean, people have offered, but ad-free since 2017. So there you go.
Yeah. Okay. Well, do you want me to do? Well, actually, that's not true. Didn't Puck do a shout out to like some window company near his house in Miami?
Yeah, he during the recommendation segment,
that was it.
his air conditioning people, and I think there was an unpaid spot. You know,
was it unpaid? So does it count if it's unpaid? I don't know.
Yeah. So if you're in Morocco and you ever do move to Miami, then you'll know who to use for. We do have a Morocco listener I saw in the stats.
Yeah.
Which is interesting. No, what's that one we were trying to get a listener for a while?
Gibraltar.
Yeah, no.
We didn't get it?
Not that I can see.
All right. Well, here we are. Another week, and the market touched another high. So the last, 4 out of 5 weeks, we've touched a new all-time high on the S&P.
Yes. Yeah.
Fun. That's great. Who doesn't love that? Happy days.
I don't know. I mean, I think the sentiment shifted this week that, maybe the economic data is softening. And we do see some signs of that. It's not necessarily a recession, but the Atlanta GDP now came out, and I think the estimate for the next quarter is only in the ones now, 1.4, 1.2%. I didn't look at it today, Jay, but I don't know. I mean, and then all of a sudden it's like, they're going to lower rates 2 times this year again. It's like, I don't know.
I don't think that was persistent after today's data, though, right? We got the jobs numbers today, and little concern about wage inflation that showed up in there. Actually, Derek, I'm looking at the probabilities on the Fed funds chart. September looks now off the table. The most probable is unchanged for September. That's the first. So now the most probable rate change occurs in November, like 60+% chance there's a rate cut in November, not in September. First time we've seen that. So that has shifted a little bit after the jobs number today. Look, jobs are stronger than expected, which... So I'd like to think about 2 ways. What makes economic sense, and then what's the market hoping for? Sometimes those are very different things, right?
Go through this, Jay, because I think this is good.
So we had hotter jobs than expected. Great. That's good for the economy. But the Fed may say the economy's too hot, so they may leave rates higher, so that's bad for the market. Then you've got the unemployment rate also ticked up a little bit to 4%. That is bad for the general economy, but the Fed may go okay, I may need to lower rates because unemployment is going up, and that can be good for the market, right? So that would be Fed lower rates sooner. And then the big one, though, is the wages, and I think that drove most of the dialogue today. Wages ticked a little higher as well, so that's inflationary, so that's not good for corporate earnings, so bad for you'd think people are making a little money. Generally, it's not great for corporate earnings, but really what it's bad for is the Fed because it's inflationary, and they will keep rates higher for longer. And that's what we saw reflected in the Fed funds futures projection today.
By the way, unemployment rate comes in at 4%. And my number was actually 3.96% when I did the math. But maybe they just round, and I didn't round. So
3.96 rounds to, if you go to one decimal, it's 4.0.
Right. So it's technically under 4. And the way you get it is the unemployed, which this is in millions, right? So 6.649 million divided by the size of the civilian labor force, 167,732,000. Okay. I always kind of break this down. And what happened was the unemployed persons went up by 157,000. The employed went down by 408,000. But the civilian labor force went down by 250,000. So let's say if you took the this month's unemployed divided by last month's civilian population, the number would be a little bit differently. Like, people came out of the civilian labor force too, and that could be people who just, age out of it or whatever, or pass away, anything like that.
And but that number has been increasing, right? The civilian labor force has been kind of ticking up, and then it dipped this month.
It has.
Yeah.
I don't know. I mean, the unemployed persons are more, but remember, these could be people who were not looking for jobs and then decided to start looking again, which could be an indication that they are needing cash. Maybe some of the subsidies have gone away. I also don't know, they make mention of this, that there's no differentiation between legal and illegal immigration. They actually say it in the BLS report. It's in there. So I have no idea how that affects this. I don't know.
So it doesn't matter, right? It's in there, right? So I don't know. So I don't think that is an interesting point, right? With, what percentage of the U.S. population is working that's illegal, and are they getting captured in this? Maybe not. Yeah. Maybe that's a debate for a different day. Yeah,
or maybe again, are they actually getting surveyed? I don't know, but somebody gives them a call and says, well, I'm here, I'd like to work, but I can't. I don't know how that works.
They're probably not getting surveyed.
But it's kind of one of those deals. Like, if you want rates to go back to zero, you want a massive recession.
Who wants that?
No, but I'm saying, if you want rates to go down, you need softening. And then, I don't know. All right, so let's talk about the markets, though. Are we done with this? I'm done with interest rates.
Done with
it. Who is this? Who put this out? This says source S&P, Dow Jones, Bloomberg. Okay, it doesn't really
Bianco Research.
Bianco. Is it on there? Okay, perfect.
It's on the bottom right, maybe. Yeah.
Well, all right, I guess I could have looked to the right. What it says, the top 5 companies. No, this says top 5, but it's top 4, Jay. Okay, so the top 4 companies are Microsoft, Apple, Nvidia, and Alphabet. 23.62% as of May 31st is the weighting. So you think about S&P 500, those companies make up almost a quarter of the weighting. And his point was, it's the highest weighting by the top 4, going all the way back to 1964, when it was AT&T, General Motors, Exxon, IBM. I don't know. I mean, some people think this is a problem. Some people don't. Where are you on this?
Concentration is always something to pay attention to, and the market is highly concentrated in these 4 names. So I think that's worth noting. It doesn't stop me from investing in the market. It's like, great. I feel great that I've got exposure to Nvidia, Alphabet, Apple, and Microsoft when I own the index, right? So, I'm okay with that. Like, if I was trying to pick stocks and I didn't include any of these in my list, because I was like, Alphabet maybe has kind of run its course, or I don't know, whatever it's going to be. I don't know. I think I'd rather would have had exposure to them in this list. So yes, I think it's something. It's hard to blow it off, because it feels like, well, if one of them has a problem, it could bring the whole market down, right? That's why people push back on this, right? I mean, I think I'm articulating, why would we care? Well, if one of them has a problem, we're too leveraged or too concentrated in a single position. However, I'm going to tell you something. The guidelines in the ETF world would say this is not overly concentrated. Like the guidelines that I don't know if it's the 40 Act or what the SEC puts out tells you, and I probably should know why, what those guidelines are more discreetly, but you could have 25% of your fund in 2 individual names, right? This is less than 25 in 4 names, right? So, this would be, the regulators would say this is not really a problem. You could launch a fund with these 4 names being weighted at 24%. No one's going to give you a pushback on it. So I'm going to do that. I'm going to say no need to push back. I understand why there's concern and risk, But, that just means maybe they're ahead and the rest of the market catches up to it. So, no, I don't have a problem. As I talk through that now, I don't think I have a problem.
Okay. I also look at this. So 1964, AT&T, I'm going to play a little game with you. What did AT&T do? I know I'm asking the obvious question. They
had to split up.
Well, not till the 80s, though. But back then, they ran residential phone service for the entire country.
Oh, you mean what was their business model? Gotcha.
Yeah.
Yes.
Right?
Yep.
So long distance. Okay. Very specific. General Motors, what did they do? Obviously.
I think they made cars. Yeah.
What did Exxon do?
I think they sold gasoline.
Yeah. Refined oil into gasoline. Sure.
Yes.
IBM, what did they do?
They made business machines.
Okay. Great. Now look at the Microsoft, Apple, Nvidia, Alphabet. Like if you covered up these names and you just looked at the different types of businesses that they're in, like cloud storage, chip making, advertising, services, devices, there's a lot of different stuff. Like if you actually broke up all these companies and made them, and this is why I started with AT&T, if you made them break up their business units into all different pieces, it's kind of more diversified than it was back then, just in the businesses. And maybe I'm wrong on that. I'm willing to be wrong, but that's my thought.
At first glance, everybody it's just a bunch of tech companies, but actually you wouldn't categorize all four of these as tech any longer, right? Alphabet's not really tech. Yes, they utilize technology, but they're not. Apple, I think, is where you were going when you talk about services and really more of a utility than anything else these days. Mm-hmm. Nvidia, definitely tech, right? They're making chips for AI. Yep. And Microsoft, again, also in kind of services, right? They sell software, yes, tech, but still more infrastructure than I would say anything else. And so when you look back at the things that you were pointing out in 1964, when you think about what society was doing, telephones, cars, oil, and then there's the tech piece of okay, we got to have technology. You're right. It's not that different from a diversification perspective. I love that you pointed that out. It's a good aha moment.
I mean, the cloud storage alone could be its own business. Google could just be called an advertising company that you said just happens to use technology to do it really well.
Yeah. Yeah.
And all right. So speaking of weightings, though,
hold on. One last question. Yeah. Aren't all four of these in the AI world, though? Right? Like when you think of the large cap companies that are playing in AI, it's these four. You could almost say if AI was its own category, if you're building an AI portfolio, you'd put all four of these in it.
Yeah, no, that's right. You would. You really would. And
you can't not.
I mean, are they picks and shovels? So picks and shovels, Nvidia definitely, because they got to make the stuff. And they all have cloud storage, right?
Yep. The distribution of the product, right? I mean, there's a big talk about Apple's going to announce, maybe by the time this podcast comes out, if they're going to include ChatGPT in their devices, right? Like this is all kind of interwoven here on AI. So maybe while diverse, maybe not so diverse.
I mean, Apple is an interesting, I think it's either the 10th or the 12th. There's their keynote at WWDC, which is Worldwide Developers Conference. I don't know where that is this year. But yeah, they're supposed to announce some stuff in AI. I sure hope they do because I'm an Apple user, iPhone user, and Siri is atrocious. I'm just being honest. So I'd love for them to come up with something really cool. And did they make a new all-time high? I'm just looking here.
They're close. Let's take a look. Oh, so close. No, they have traded at 199.62. Today closed at 196.81. If you want to go by closing high, sorry, I'm on the weekly, Derek. Let me go to the daily. 3 minutes there. Closing high.
It's close.
It's really close. Closing high, 198 even, and today it's 196. Look, this is, if you were to ever make up a triple top chart, this is what Apple looks like. Is it going to break through this, or is it going to go back down? Who knows? Interesting. Or
is it
chart.
A W? All right, so here's the interesting one. Maybe this is a little, we do those friendly wagers for no money, just bragging rights. So there's two ways to look at this, and you can let me know which one of these you'll take. One is they come out with an AI announcement. It breaks through the triple top resistance, and it's just off to the races. The other is sell the news, buy the rumor. The rumor is they're going to announce something next week, really cool, but it's going to sell off, and it's going to go back down to the bottom end of the range. So flip a coin. Which do you want there?
I'm in the buy the rumor, sell the news camp. That this is probably. Again, I have no information on here. Happy to be wrong on all these market calls. But yeah, I say it's probably, I don't like the lower lows that it saw from October. Then we got lower in April. You got this gap up going on there. Yeah, this is all rumor. You got to sell the news when it comes out.
All right, I'll take the other side. It's breaking out to all-time highs. Well, and by the way, we both can be wrong. It might just be flat.
Fair enough.
Don't trade off that, really. I mean...
Yeah, what do you say? So you're saying 205 before I say 185? Is that 10 points either way about? 205 before 185. There we go.
Let's go with that. I'll write that down.
It's a long term. I'm sure Apple continues to. I shouldn't say I'm sure. I like Apple long term, and I hope it goes up. It pulls the market up. All great things when Apple's up. Don't get me wrong.
Yeah.
But yeah.
Well, not a recommendation either way. If you want to hear more about portfolios that we run and hedging we do for clients, you can always drop me an email, derek.moore@zegafinancial.com. Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial is up to you to get correct. If you can't get that correct, you're not going to be able to reach me. So
we're probably not for you.
Let's go. Oh boy. No, you can do a Google search. If there's plenty of info there. All right. Nvidia. I don't know if you saw this. It is the second largest company by market cap. They passed Apple and the S&P 500. The question is, do they pass Microsoft?
I mean,
or does Apple? Does
Apple take it back this week, right?
Yeah.
Does Apple get a chance to do the resurgence? Well, I already just told you what I think about that. Look, I talked to an investor today, and his thought was Nvidia is the GOAT, right? So this is the stock to be in, and it's the one setting the market tone. I think it could pass Microsoft. I think it can. I think it definitely can do that. I mean, it's not, how far off are they? What's the difference? 3 billion versus 3 trillion versus what's Microsoft right now?
I should know that, but I don't. I just have the percentages. Yeah. It's 6.96%. This is as of the 4th. 6.96% weighting for Mr. Softy and 6.48 for Nvidia. So,
yeah, all right, a little ways to go, but still, yeah, absolutely Nvidia can pass. I mean, if you're a momentum guy, look at that chart. It's wild, right? Up and to the right.
Up and to the right. All right. Well, speaking of NVIDIA, I think this is Jim Bianco, too. Let me see. It is. There you go. Bianco Research. Nice. Thanks, Jim, for giving us this content. So, NVIDIA and the Fabulous 3 impact on the S&P 500. Okay, now we're not Fab 4, we're Fab 3. So, as of May 31st, the S&P was up 9.31%. This ties into our idea, is there too much concentration or weighting in the top end? 9.31% year to date. I don't know if that's total return or price return, and then you go, okay, so the S&P 496 contribution to the S&P 500, of that 9.31%, the rest of the market's up 4.3%. So not bad at all. Amazon, Meta, and Microsoft contribution was 1.05%, and then Nvidia all by itself was 3.96% of that. So, I mean, I always, when people show me stuff like this, I'm like, yeah, duh. I mean, this is why you buy an index, because let the market sort itself out which one is contributing. But
I mean, if you thought Nvidia topped out at the beginning of the year and you said, look, I just don't like the concentration of this one stock that's run up so fast, it had its push. I mean, it's kind of notable that it is responsible for almost 4% of the 9.3% gain all by itself.
Yep.
Yeah, that's definitely notable. So its growth and contribution to market cap almost matches 496 of the other stocks of the S&P. Yeah.
I mean, but earnings, when we see S&P 500 earnings per share, which is throw all the earnings in a basket, and then you whittle it down to a per share basis. Like, you aggregate the earnings. So if you have a couple monsters in there just supercharging the earnings, it's going to help your whole index. And Nvidia, by the way, I should have gotten a chart of this. I'll have to try and pull it up. I'd love to see a chart of the weighting, their historical weighting of the S&P 500. They weren't this much of the S&P 500 3 years ago. They weren't this much 2 years ago. So, And here's the other thing. If you're worried about concentration, Jay, you've said it time and time again. It is cheap to hedge right now.
Right. And so let's face it, if Nvidia sells off, right, if that's the thing and you're worried about this concentration, we just talked about how it's such a big portion of the market appreciation. If it goes down, it should pull the market down by the amount that it went up generally. And so your hedge will work in a cheaper way than buying a hedge on Nvidia by itself.
Yeah, no, that's right. You could buy, let me see, if you were, let's say you're like, oh, by the end of this year, I think it's too concentrated. I'd rather sell. Okay, you could do that, and that might be a good decision. What do we know, right? Or you could say, oh, I could protect the next, 20%, at the money, 0 to 15% or 20% down. And it's, what is it, like 3% it would probably cost you to buy maybe like a little high 3% to buy something like 15% down. I'm looking at my chart is, but anyway, yeah, it's pretty cheap right now to hedge. So.
Look, if you're like, hey, I'm worried about the election, I'm worried about Nvidia. If I'm just taking a look at an at the money put, Derek, in the S&P, like the 5,300, we closed today at 5,346. So let's just say the 5,350.
Sure.
But, if you just thought, the market might have a little wiggle, I just want to buffer myself against the first 10% down, right? That 5,350 is, I'm going to give you, these are annualized numbers, right? Because I could give you the number and then do all the division. But like December's just, like 6.5 months away. But on an annualized basis, you buy the 5,350, it'll cost you 5.3% on a year annually. And then you sell the 4,800, which is 10% down. That's 2% annually. So you're right. So for 3.3%, it would cost you annually, which let's take half of it. So let's say 1.7%. That would cost you to throw on this hedge, 5,350 put long by a 4,800 put on the S&P. And now you've just given yourself like, hey, if the market drops, the first 10% minus the cost of the hedge, I'm not going to experience. It's pretty affordable from what you and I have seen through the years.
It does. It ties into, can we take a listener question, Jay?
Yeah.
Can we do this?
Yeah.
All right. Big Al. Thanks, Big Al, for being a listener. Appreciate the question. Got a couple questions I'll read today. One is, would it be wise to buy CDs now as a hedge? And I'll say also, CDs, or let's say T-bills, 3-month T-bills. He didn't ask that specifically because he believes interest rates higher for longer are starting to negatively impact the economy. Jay, I don't know. I think given where the cost of hedging right now, it's one of those things. If you could go into, let's say, a T-bill or a CD and you know what you're going to receive, but if the market continues higher, you're going to miss out on that. So I don't know. Is a hedge...
I wouldn't say it's a hedge, right? Yeah. Hedges appreciate when your underlying investment declines. And maybe you'll get, let's just say you know what to plan for as your return on a CD, which I like your idea of treasuries. They're liquid. You could just get it, where a CD, you're kind of locked in. That money's tied up for a while. But no, I would say not a hedge is a good way to take risk off and get paid while you wait. Sure, if you're worried about the market selling off, what I just said could cost you 3%, but you keep your upside exposure. If you do this, you're going to make your 5% on a 1 year or a 6-month treasury or CD. You should make 5%. And that's what you're going to make, right? So then if the market goes down, you can be like, well, the CD, the treasury would have been better. But you've taken off, your upside capture. So I guess you have to be it's a market timing call. Not great at market timing. I always lean on, keeping the long exposure and putting on the protection. But If you were like highly confident the market was going down, yep, then you go to Treasury CD rate. But I don't know how anybody could be highly confident about that right now.
Yeah, I mean, who knows, right? I also say I probably should have put the caveat in. I mean, this type of question is very specific to one's own circumstances. So, just kind of taking it off the cuff and saying, yeah, I mean, that's kind of our quick reactions there. But, it's a lot different. Somebody says, oh, I have a payment for my kid's Harvard education. I'm paying all 4 years up front in 2 months. And that's all the money I have. Like, that's a different conversation.
That's very different.
I have a very big portfolio and I'm trying to time the market. So yeah, I'm a fan of that, of the hedging in that case rather than. Okay. So that aside, keep the lawyers happy there. I had 2 questions. Al actually asked a follow-up question, and then Ryan had a same type of question. And so let me do this. His question is from Ryan. I saw in the news about how regional banks are on the brink of insolvency due to residential mortgage delinquencies. How and when would those unrealized losses become realized? And then Al said, speculated we'll soon see high failure rates among small and mid-size. Do you think this would happen? Okay. So I always, when I get questions like this, or just I see things like this, Jay, I like to go and pull some of the data and see what's the data say as far as those.
Yeah, like what's the trend look like? Is it worrisome? Right, of course. Yeah.
So the MBA, which is not Masters in Business Administration, it's the Mortgage Bankers Association National Delinquency Survey. This was as of May 17th. So not, it's a couple weeks old, but it's fairly recent. And it looked at all loans, conventional, FHA, and VA loans. And this was non-seasonally adjusted, includes 90 plus day. Okay. So seriously delinquent rates by loan type. It looks like all loans were about 1.44% were delinquent 90 days or greater. And it's been trending lower. I mean, it rose 2020, not surprisingly, but started coming down in 2021. Jay, the data here looks like residential mortgages, at least from what I'm seeing here, not having a lot of delinquencies.
Yeah, I mean, I was curious where the listener call came from. Asking. Of course, delinquencies are important to watch. They definitely have a correlation with the economy and then bank failures along with that. Of course, I'm with you. I don't see that as a near term problem. I would lean more towards delinquencies in the commercial space as being a bigger contributor to a bank problem. That to me is we don't really know the scope of that problem about commercial real estate. Are people really going back to work? I mean, we're on year 4 here, year 3.5, and people are still talking about go back to the office. I don't know, if you owned real estate and you've been paying a mortgage on this thing, I'm sure you've brought in a lot less of rent than you did back in 2019.
Isn't it also? Yeah, I agree on the commercial. That's one of those things. I mean, we're not. I don't claim to have expert knowledge in that space. I don't think you do either. That's different focus than ours. But I feel like we don't yet know, because there could be, and I've heard people talk about this, the extend and pretend. So you extend the loan to sort of bring down the payments, and the pretend is...
Oh, that happened all through the great financial crisis, 07, 08, 09,
sure.
Of course.
Sure. I did look, the FDIC puts out a quarterly report. I'll put a link to it in the show notes. I'll put a link to this MBA data as well. But it's FDI insured institutions on the problem bank, in quotes, list. This is 2012 to 2024. It looks like 63 banks are on the problem list. In 12 of 12, so December of 2012, it was 651. Now, when you look at this, it says, well, many more banks were in trouble back then. I don't know the size. There's been a lot of consolidation. So a truer picture here, would be the number of banks as a percentage of the outstanding banks and things like that. And I will say that they missed. I don't think was it Silverstone? What was the bank that went
SPV?
Yeah, I don't think they were on this list by the FDIC when they had a blow up either. So
why would they not be on the list?
They weren't.
Okay.
And then this is assets. So assets on the problem, there's 82 billion in assets that are on the problem bank list, 170 billion at the end of 2021. So it's come down there.
It's kind of the average back to 2018, right? Kind of.
Yeah, I mean, if you look at a longer term chart, and Jay, that's in your packet there. That's chart 9. Well, it's labeled chart 9.
Like Derek gives me all this homework, and I never do it ahead of time. So
that's right. I'm walking you through it
on the fly with him.
This goes back to 2008, and this is number and assets of banks on the problem list. There were over 800 banks in, it looks like 2009, that were on the problem bank list, and not inflation adjusted. It looks like it was something like 450 billion. So like in today's dollars, it'd be a lot. So we're a far cry from 08, 09, 10, 11, 12. I don't know.
Okay.
But here's the thing. There are unrealized losses on investment securities. That's the next chart, Jay. I
like how you put chart 8 after chart 9.
I'm not the one who labeled them that way. I didn't like the order. I like my order better, Jay.
I like your order better too. Good work.
Yeah. So this is the thing. There's something like, I don't know, probably between 400 and 500 billion of unrealized losses through the end of 2023 that banks were holding. Remember, banks, they have liabilities, they make loans, but they take deposits, and sometimes they'll take those deposits and they'll buy longer term bonds. As interest rates went up, bonds prices go down. We know that the Fed had that facility. They allowed banks to essentially get par value by exchanging the bonds with the Fed facility. This to me is still a problem. And I don't know if it might affect, I think it affects the bank's ability to make money. Although I got to be honest with you, we had a bunch of these. The Fed stepped in. I think the Fed has sort of signaled that if there's any problem, they're going to backstop it.
Yeah, they'll backstop their own paper, of course.
And I think, JP Morgan Chase, Wells Fargo, Citi, I mean, they're all just going to get bigger. They'll gobble up some of these other banks. I don't know.
Well, look, this is the thing that caused the problem in 2020. Gosh, what year was that? I'm just kidding. That caused that little short-term mini financial firm disruption, right? When you got the SVBs of the world kind of going, oh, sorry, we didn't know that these 10 years treasuries that I bought could be a risk, right? And when interest rates went up so quickly, their value dropped and they made loans based on the idea that that was going to be, fully maturable to par. Then there's a run on the back and they had to sell it. All of those... That's what this is reflecting, Derek. And you're right. The bailout, I'm going to say the mini bailout, like the Fed stepped in, they'll probably step in again. But if there's something to look forward to with lower rates, it would be a little relief in this aspect of kind of the bond world, where there's financial institutions that hold the longer term paper and they've got these unrealized losses on their books. That starts to get a little relief, right? That is, to me, one of the bigger things. Which is why the financial sector would look to benefit. One of the reasons why the financial sector would look to benefit from lower rates. It's this. Some of this risk would be some of the air would come out of this potential balloon that may pop.
Okay. Yeah. I mean, I think it's something we watch. I mean, I agree. There's ramifications here. Another question, this one from Ryan as well. We love the questions, by the way. John Carter talks about how he monitors transports index as a measure of the economy. I guess I'll take this one. Do your beloved shipping container rates have a similar correlation besides inflation cost of the container unit itself? Yeah, I mean, what I would say here is I look at a site called freightwaves.com. And FreightWaves is sort of an industry thing. They have conferences if you're so inclined. I haven't been able to make the argument to go to that conference yet, but I'm sure it's a good one.
I feel like you personally would pay for it. That's what I mean.
Well, I think it is. But in all seriousness, Dow theory goes back to when the Dow Jones Industrials were like the major index. And the idea was the industrials, so think about manufacturing. If the transports were going up, or let's say the industrials were going up, but the transports index were going down, the Dow theory says, well, those don't confirm. And it shows that, that could be a leading indicator. So Dow theory says the transports and the industrials should be acting the same and confirm each other. On container shipping, if you go to FreightWaves, you'll see some interesting stuff. You'll see little things that show up, like how many, what's the backup at ports? Are trucking companies, are they turning away business because they can't, there's so much stuff being shipped. So without, I'll have the audience fall asleep if I start getting into this. But check out FreightWaves, and yes, I like looking at things like the shipping container rates, at the volume, at the time in port, all those types of things. And then trucking's a whole different things. And then freight via airlines. These are things that sometimes it's kind of, let me give you the analogy here. And Jay, I think you'll like this. You remember for a good part of a decade, I was traveling every week, sometimes more than one city. I would always look at this one parking garage. It had like 8 levels. Well, it still has 8 levels, but I'm saying when I travel at 8 levels. And when things are really, really good, usually you can only get a spot on level 7 or level 8. When things are bad, level 3 is available. So it's just one of those off the cuff indicators that I used to look at, and it was always right. Like you could tell when you started to get into lower levels, oh, okay. People are cutting back on business travel. It's not showing up yet, but they're cutting back. So, all right.
Transports matter is what your point is, and I would agree with that fully.
Let's talk GameStop.
What's that? Ooh.
Well, roaring deep effing value guy, that guy.
Roaring Kitty, yes.
Well, he's one of the same. Deep value and roaring kitty.
Okay.
I think he's the same.
Oh, okay.
So I guess he posted his position. He's still got a pretty big position. But I thought it was interesting, and Jay, we have about, I know we have a hard stop today, so we got 11 minutes. We got to talk about this. GameStop, who the heck is trading the 128 call options that expire today?
And the market makers hate these things. Go ahead.
Yeah. So to set the stage here, we look at a report here. There are 84,000 lots of volume today on the 128s, and the last price was a penny. So these are going to expire worthless, obviously, because GameStop's around 27, 28. But the open interest coming into today was 57,000. And then I look at next week, Jay, the 128s have the highest open interest. They're like $1. They're a little bit over $1. 58,000 lots traded today in volume.
Hey, what's the price of GameStop?
It's 27.
27, and this is the 120s we're talking about, right? 120. Go ahead, 128. Yeah.
So open interest could be an opening transaction could be as a sell, could be as a buy. Like, who the hell is trading these 128s?
Well, look, this is the thing about these. So, I mean, it's speculators one way or another. Like if you're selling the 128 call because you're like, ooh, these things are juicing, it's never going to get there. You're still taking, risk. You're getting paid, $1 on a $26 stock. Like that's pretty amazing to be that far out of the money. What is that? 500% out of the money? So it's one of those things that this is look at the money retail shops, right?
It's 450%.
450%. All right. I was close on my.
So it's 4.5 times out of the money, right?
Out of the money. Yeah. So sorry if I said in the money, out of the money. So this is retail. This is the individual saying, I'm going to play a little bit here. I see some volume here. Sure. I like to sell that or I'll buy that, right? Because if I'm right, and even if it gets close, right? If Monday or Tuesday this gets close, you may be able to get out of those for $5. But if it may only jump up to $50. It may only do 100, which it seems to be doing 100% changes pretty regularly these days. You go, oh, maybe this is risky, and the poor person on the other side of it that sold it is going to have to cover. Look, this is some market maker, right? Market makers are trading these things, and they're going to have to trade the underlying. And you could have this kind of, we've talked about how the change in the price affects, the option positions that the market makers use to get neutral. Let's not go through all that. That's a whole show in and of itself. But I think it's the individual, Derek, and I think they're just having a little fun with this. What else is going on? It's a boring summer. Oh, wait, next week we got CPI, PPI. Somebody said there's a Fed meeting. There's other things to pay attention to. But you know what? I think the home gamers, I bet the Gen Zers are back. They're trading. They're loving it. They're logging into the Robinhood account and throwing on some trades just to see what happens. They want to have a front row seat.
I hope people understand, if you're paying $1 for the 128 call that expires next week, good luck. And it could go to 200. I mean, there's no rhyme or reason.
What's the price? What's the probability on it? I didn't look at the probability.
Oh, hang on. I have it up.
Yeah.
Probability of the call side. It's 0. No, that's today's. Yeah, obviously today's is already, of course it's 0 because it's expired worthless. The probability is
still 0.
Yeah, 0.05%.
So you just paid something for a 0% chance. That feels like...
No, 0.01%. So you're saying there's a chance, Jay.
So you're saying it's a chance, says Mr. Christmas. All right. Well, it's wild. Probably people are happy to sell those.
And don't sell it either, because you'll be the one who sells it. And all of a sudden it goes to 200 and you get your face.
It doesn't even have to go to 200. If it goes to 50, this thing is all of a sudden going to market $5 on you, right? And then next thing you know, that's pretty decent loss.
Yeah, and your brokerage firm can use like a VAR type margin thing. So you could actually think you have the ability to put this on, but they'll hold a much higher requirement on this. All right,
They may hold you to $128, the assignment value, right?
They could.
They sure could.
They could. All right. Anyway, it's like, really? Who's trading that? All right, Jay,
when did you get this? When did you take the screenshot? Right.
It was about a half hour before the close, 20 minutes.
Yeah. Now there's 77,000 contracts that traded there. So there was even enough. You said 58. There's 77,000 contracts that traded there. Something's going. That's happening. That's happening.
Well, they had to get out of the ones that expired today and go to the next ones.
No, I'm saying the next weeks.
Yeah. You already lost money today.
They lost that and they're going here. Yeah, listen, you're going to throw $1 away a week. All it takes is 1 week to pay for a month worth of playing around. There you go.
All right. The other thing, I'll just say this before we go to recommendations. There are some people who have said publicly, and these are people in our business, take a couple percent of your net worth or up to whatever. And, there you can take some speculative. I don't necessarily agree with that, because that's you do it once. Like if you keep taking 5% of your assets and you keep making these wild bets, like it sort of adds up. And people aren't going to like that. I know I'll probably get emails saying, well, you don't know what you're talking about. Anyway.
You're too conservative. That you'll get the too conservative, right? It wouldn't be the first time you've been accused of that, Tarek.
Yeah, these are tough because if you sell it, you can get your face ripped off. High margin requirements. If you buy it, you're likely to lose money. At least the probability. And it could go to 500. It could go to 0. Remind me of this though. I looked at his initial cash flow projections. I went back and I watched the video, so you don't have to, Jay, of Roaring Kitty, like 4 years ago.
Uh-huh.
And he did his cash flow, his next 4 years cash flow predictions. And let's just say they were a little off. All right, Jay, recommendations.
You know what? I'm gonna come in. I'm gonna come in empty this week. I haven't really. I don't have any new recommendations for you this week. It hasn't been that kind of a week for me.
My son went to go see the new Planet of the Apes movie, and he gave it a 7 out of 10. He didn't seem too enthused about it though in the theater. So there you go. And I'm almost embarrassed to tell you I watched this movie, but I watched it on Netflix. Anyone But You? Is that the name of it?
Yep, it is. I saw it show up. I did not watch it myself. So you got a little rom-com in there.
I got to be honest with you. Not a lot of rom-coms, and certainly not in the movies. So it was a rom-com. There were entertaining parts. I'll say that. But it's, it was a perfect by the script rom-com. You were probably too busy watching Barbie again, is my guess, right?
Well, based on your recommendation, sure.
It's not. I've never.
See what I did there? See what I did there?
I'll never see that movie.
Listen, I'm still watching Dark Matter. They've yet to mention the words Dark Matter in the show yet. So I'm still waiting for that to matter.
Maybe next week. Read the book. All right, Jay, that's it.
Thanks, Eric.
See you, everyone. Take care.